All right. So as you guys flow on in here, there's a whole bunch of people coming in. It's Tax Tuesday. I'm Toby Mathis,
Elliot Thomas.
and we're going to be your hosts. And they always make the ESQ on our names, like in all caps. Whoever's doing that, stop it. It makes me like ESQ. That's really big. Plus, I can't see anything today. All right, flow on in and we'll get started. If you've never been to a Tax Tuesday before, we're going to go through a whole bunch of questions that Elliot here picked that we're going to go through because people email all along. We'll give you that email as where we can email in questions. How many emails are we getting?
Well, we go anywhere from 100 to 300.
100 to 300 questions that get emailed in. And then you pick what, 10?
Yeah, we got 9 today, but yeah, typically 9.
9?
Yeah.
So it's going to be a short day.
Yeah.
All right. And then we have a full team on that's going to answer your questions. Here, I'll just go over the rules. You can ask your questions. Like if you have a question about your taxes or a concept, or you're like, hey, I'm selling a property and blah, blah, blah. And how's this 1031 exchange thing work? You can put it in the Q&A. There's not a cost to it. Elliot might send you a bill later if he finds out who you are. No, we never send a bill. We just answer your questions. And we got a whole bunch of folks. We got Troy, Rachel. Hey, Rachel. Jeff, Dutch. Gosh, these guys are in the middle of tax season. Arash and Amanda, tax attorney. Patty and Matthew floating around out there. So they'll absolutely answer your questions. My gosh, we got some horsepower on there. So if you have tax questions, now's the time to ask because there's a whole bunch of accountants and tax attorneys there to answer it. You do that in the Q&A. The chat, that's a little different. The chat, you could just put comments. So you could say like, hi, Patty. There's people that always do that. You could also say like where you're from. Hey, that would be cool. Put your city and state, and your state should not be drunkenness, right? It should be wherever you might be. And let's see. Let's see where everybody's from. Put your city and state in there, and that way we can. Oh, Tacoma, Washington. That's Joe. I know that area well. That's where I went to school, and we have an office there. Salisbury, Houston, Odessa, Las Vegas. You're in my backyard. Charlotte, Houston, Berkeley Heights, New Jersey, Crystal Bay, Nevada. Wow. Beverly Hills, California, San Rafael. My gosh, they're going through so fast. We get hundreds of people on these, sometimes thousands, usually hundreds, though. Patty is incredibly popular. We're getting that. San Diego, bad taste is timeless. That's just mean, isn't it? Patty, what can we say? Patty, where's no, Patty is awesome. Patty is, yeah, we love Patty. Anyway, so we're making fun of Patty. Baltimore, got a bunch of properties there. Some days, fortunately, other days, unfortunately. Miami is where I met my wife. Wonderful. Douglas County, another Miami. Well, look at this. Hi, Toby. Always enjoy joining you in Elliot. Thank you so much. We love having you guys. Otherwise, we would be sitting here in a room. I don't know what we'd be doing. It's our hour every, they let us out for an hour every 2 weeks. This is what we do. And they put us back in our cages. All right, enough of that. The idea here is to answer your questions and to have a little bit of fun while we're doing it. I want you guys to learn. Yes, somebody gives us a heart. We want you guys to start embracing the idea that taxes is kind of a game. There's two paths. There's those who know and those who don't. And for once you start learning about this stuff, it really is kind of addictive because you start realizing that nothing's as straightforward as everybody likes to pretend. There's always shades of gray. There's always nuances. And if you get out ahead of it, you can make a huge difference. Somebody says, my name is Francis from Georgia. I love that. Are driveways and fence installation deductible on primary residence home? See, I love that you're putting it. First off, put that in the Q&A. Second off, no, it's personal property. Got to make it into an investment property, Francis. But you could always add it to your basis to the property. So if you sell it, you don't have to pay a bunch of taxes. But that's what we're here for, is to answer questions like that. We love it. And I don't mean to make fun of anybody other than myself. Maybe Elliot, maybe Patty. No, hey, it taxes. The only dumb question is the one that you don't ask, and you want to make sure that you're looking at all these things. Then you start learning some patterns. There's definitely rules that incentivize investing, huge incentives if you know where to look. And it can make a huge difference. All right, let's go over the questions that we're going to ask today. And we're going to go through each one of these and we're going to answer them individually, but I'm going to go over them what they are ahead of time so you know if something's pertinent to you that you perk up when it comes. As a tax strategy, let's say I forgot my glasses. No, as a tax strategy, let's say I set up a trading LLC entity and a C-Corp entity that owns 49% of the trading LLC. If the trading LLC makes around $10,000 in staking income, that's interesting. And the C-Corp gets its $4,900 as a partner in the trading LLC, then can the $4,900 be used to fund a 401k owned by the C-Corp? Is the income considered earned income or ordinary income? If it is ordinary income, can it be used to fund a 401k? Good questions. That's kind of a crypto, if I'm not mistaken. I currently invest in crypto. There's another one. I anticipate selling some of it sometime in 2025 with gain over $100,000 or perhaps far greater. It's crypto. It could quadruple in a day, right? What would be the best move for me right now? If I were to create my LLC, would I be taxed when I move my crypto to the wallet for the LLC? All crypto would have been bought more than a year prior to selling. Should I create an LLC this year or wait until next? Great question. We'll get into it. How do I save taxes on flipping houses? We have 3 houses we are flipping in the next few months. You're a brave soul. How can we reduce the taxable income on these properties? We'll go over that. I bought a short-term rental. So STR in our world is short-term rental cabin in May of 2022 using 1031 funds. Rentals are beyond disappointing. At this point, if we sell for at least $200,000 loss, more than the gain on the 1031 funds, how does this play out regarding taxes? So we'll go over that. I'm sorry you're having a tough time on those cabins. I have multiple LLCs. Do I have to file multiple tax returns? Wow, good questions. Wait. Elliot's doing good, right?
Plenty of time to go longer.
I've had my primary residence for the past 21 years. If I rent it for 3 years or more and sell it, would I be taxed on the depreciation I take over those 3 years, or would it be included in the 10 or the 121 exclusion? Interesting question. I like this. That's a kind of a funky one.
Yeah.
If I have a 2-level house and I live in the upper level, but Airbnb on the lower level, can I deduct the depreciation, repair, management of the lower level? Does it need to be a legal unit, have its own address? Same question, but what if it was a long-term rental? So really good questions today. Like, I actually like it. A couple more. If I am a real estate professional over 750 hours actively acquiring properties, and I sell my other long-term non-real estate investments, such as stocks, private equity, venture capital investments, then can the losses from my active or passive real estate investments offset gains on my other long-term non-real estate investments? Wow. So it's a capital gain question. And then there's another one. I could
Yep.
see how your
Yeah.
brain works. You're like, oh, let's get a
There's a lot of pieces to it.
Yes. How do you minimize capital gains when you sell a condo that you lived in for 2 years that has never been rented and is not your primary residence? So it's just a second residence, and we'll go over all that. So great question, Mr. Thomas. Elliot painstakingly goes through these and picks them. Hey, if somebody gave you a heart, if you could, give Elliot a reaction, even if it's a cry emoji, because you're so like, oh my God, Elliot. There's some cry emojis. See, Elliot likes the weeping. He laughs when people cry. He's oh my God. What's wrong with you? What's wrong with you? The child is crying and
We
he's
don't have
over
enough time on the show for that. What's wrong with Elliot?
All right. Yeah, we'll have that would be a good one. What's wrong with Toby and Elliot? We should get some professional help here. All right. Hey, if you like this sort of thing and you like learning about taxes and wealth planning and taxes and more wealth planning and asset protection and more wealth planning, you can go to my website or go to the YouTube channel I have a channel, and then also Mr. Coons has a channel. Where's Mr. Coons? I don't see. Does he there? Well, he has the workshops here. I'm going to do this. Maybe Patty would be so. Maybe you probably already did it. They're way ahead of me. Yeah, go to Clint's channel too. Don't neglect Mr. Coons. He's been my partner for a long time, since 98 or 99. And his is more on the asset protection, but his is a great channel. If anything, if he ever does anything good, you could pretty much count on me just stealing it and doing it on my own. No, I'm just kidding. We tend to swim in different waters, but he has a great channel as well. If you like this sort of information. Speaking of liking this type of information, toot toot, is if you want to learn more about how the entity structuring works, and you want to learn how LLCs, corporations, land trusts, everything works for your real estate investing, join us at one of our free tax and asset protection events. We do the virtual events absolutely free, and the live in-person events. We have one coming up, it looks like in September in San Diego, and those are really fun. We get together. If anybody's been to a live event, maybe give it a thumbs up, or if you thought it was horrible, you can always give it a cry emoji. But if you've been to the live event, then there we go, a bunch of you guys. They're kind of fun. They're a get together, and we are a big goofy family where we like to do things like investing together. We like talking about these things. We're all kind of sick in the head as far as we like to not overpay our taxes, and we just have a lot of fun together. And if you like that sort of thing, you can join our family. It is a big family when we get together, because it's hard to find a bunch of investors that think kind of similarly and are trying to do things together without, you could join some real estate groups and things in your local area. But when you're really thinking about the United States, it's you want to be around people that are looking at the entire country as well. All right, let's dive into the questions. As a tax strategy, let's say I set up a trading LLC entity and a C-Corp that owns 49% of the trading LLC. So right off the gate, it's an LLC taxed as a partnership, and the corporation is a 49% partner. If the trading LLC makes around $10,000 in staking income, if you don't know what that is, it's a crypto term for basically you're getting paid ordinary income for verifying transactions, using your computer to verify. And the C Corp gets its $4,900 as a partner in the trading LLC, then can the $4,900 be used to fund a 401k owned by the C Corp? So we'll go over that. Is the income considered earned income or ordinary income? If it is ordinary income, can it be used to fund the 401k? What say you?
All right. So first of all, just going back at it, I can't help but just say, why would we do this kind of partnership that Toby was talking about? Is because if we didn't have this and we had that $10,000 of income coming in from staking, it's all going to be ordinary income to the individual, subject not only to income tax, but also employment taxes. So by doing this, putting in the structure as the individual asking the question did, automatically we kept $4,900 off the personal return. So that's a victory right there, good tax plan. But once it's in the C corporation, then to get the call of the question here, first of all, is it earned income or ordinary? Well, we don't really look at it that way because it's in the C corporation. What we do know is it's going to be taxed at a flat 21% if we don't do anything. But we have a lot of things to help us out in the C corporation. One of them, they could pay you a little bit of earned income as a W-2 wage out of that $4,900, you as an officer. And then, yes, you could contribute there from your wages into the 401k, or if you took, let's say, half of that amount, maybe $2,500 as a W-2 wage, you could contribute as the employee to your 401k, and then the employer, the C Corp, could contribute out that $4,900 as well into the 401k. So the quick answer, yes, you can get it into the 401k. We do have to have some earned income, W-2 wage to you as an individual, as an employee, before the C Corp can start contributing to it. But really, in this case, we would only look at it as earned income as you as an employee receiving the W-2. But yeah, it can be used to fund the 401k.
Absolutely. So what Elliot said, but yeah, so it can absolutely, once the money's in the C Corp, usually you're getting it out tax free. You're doing the administrative office for the home, you're doing 280A, you're doing ordinary necessary business expenses like, your cell phone, your computer. That $4,900 is going to come out tax free. But if you wanted to get it into a 401k, then yeah, you could contribute up to $23,000 into that 401k of income that's paid out to you. Plus, if you're over 50, I think it's an extra 7,500 or thereabouts. And then the company could also make a match of 25% of the amount. So if you took out a salary of, let's say, 2,000 and put it directly into the 401k, you wouldn't pay any tax on that. There's some employment taxes that would be due, which is about 14%. Part of it's from the business, part of it's from, taken out of your check. So it's not quite straight 2,000, but then the company could put another $500 on your behalf into a 401k. But at these dollar amounts, $4,900, that's an administrative office for the year. Usually you're going to get that out tax free. And like Elliot said, what's the big difference? Well, whatever your tax bracket is, that let's say that you had $10,000 in staking income, that's ordinary income, that $4,900 would have been taxed to you before, and then you would have had to pay your expenses. So by doing this, you just eliminated $4,900 of taxable income. What is that worth to you? It depends on what your tax rate is. If you're in the top bracket, obviously, it's going to have a much bigger impact than if you were in the lowest tax bracket. So it's always a personal question, but regardless, you'll be able to get that money out tax free. Yay, we like tax free money.
Yep.
It's called an accountable plan, and they're available on S Corps, C Corps, 501c3s, LLCs taxed as S Corps, and LLCs taxed as C Corps. They are not available on partnerships or sole proprietorships generally. Okay, let's go to the next one. I currently invest in crypto. I anticipate selling some of it sometime in 2025 with gains over $100,000 or perhaps far greater. That's awesome. What would be the best move for me right now? If I were to create my LLC, would I be taxed when I move the crypto into the wallet for the LLC? All crypto would have been bought more than a year prior to selling. Should I create LLC this year or wait until next year?
So this is why I put these questions together, because it is all in the crypto realm. And here we have someone who's thinking about setting up the LLC, maybe the trading partnership. Either way, partnership, or if this was just a disregard LLC, meaning it doesn't file its own tax return, it's basically that taxpayer. Either way, when we put the money in, it's not taxable. But something we got to hold on to is that we already have a gain. We have 100,000 plus a gain, perhaps more. When we put that in, if it's a partnership, we actually are supposed to kind of track that and make sure we understand where that gain came from, which partner or whoever put it in, so that would still be attributed to them if it was later sold. But any additional gain, if we're at 100,000, let's say it went up to $1 million, another 900,000 a gain, then being in that partnership, just like Toby went over on the previous question, we're going to do all those great things, all those reimbursements, corporate meetings, accountable plan, pay a little wage, put it into the retirement plan, all kinds of good stuff you can do there. So that's what's going on. The fact that the crypto had already been held a year, as I recall, yeah, when it goes to the partnership, I don't think it restarts the
No, it doesn't. It
yeah,
doesn't
following
change
it.
anything.
Right.
I mean, it always depends on who the partners are, right?
Mhm.
And if I come to the table with a bunch of crypto and somebody else comes in with a bunch of cash, we have some recognizable gain there, perhaps, because we have dissimilar assets being put in, even though people think of crypto as cash, they're different. It's kind of like there's a great case. It was old Boeing. I think it was the Long Acres Racing Park where Long Acres contributed the real estate and Boeing put in a bunch of cash, and then they dissolved the partnership. And the one party took the cash, and the other, Boeing, took the land. They built a bunch of offices on it, and they managed to avoid having a taxable event in Washington State. They changed the law after that and said, hey, you can't do that. But so there's some rules there we have to navigate. But if this is just you, I'll just make it simple. If this is just you, you could set up an LLC to protect it, no problem. You could set up an LLC and a management corp if you want to do some tax mitigation. It's still going to be long-term capital gains. It does not reset your time, and it does not cause recognition of gain. Whatever you contributed at, it gets your basis. So it doesn't hurt you. But if you have that much gain in crypto, I mean, word to the wise is I'd probably take some of it off the table, right? Even though it might go up even more, you never know. But if you have some gain, I'm always a big fan of, hey, if it's gone up a bunch, maybe take a little bit off to make sure that I don't regret not having done so. More fun stuff. How do I save taxes on flipping houses? We have 3 houses we are flipping in the next few months. How can we reduce the taxable income on these properties? What say you?
So the real common thing that we use here, approach here at Anderson, is we often would put our flipping activity maybe in a C corporation, possibly an S corporation. Why? Because again, we have a lot of ways to mitigate taxes on that with reimbursements, corporate meetings, et cetera, wages that you use to contribute into a retirement plan. So then you don't, just from an asset protection standpoint, you certainly don't want to do it in your name. Otherwise, you're fully liable there. So certainly that's the way we'd want to go about on saving the taxes there.
Yeah, so when you are flipping, this is no different than any other business. When you're flipping houses, you're treated like a car dealership. You buy the property and you hold it in inventory, right? And so if you put money into the house, it's no different than if you add components to a car on a car lot, right? Hey, I put better tires on it, I painted it, and I do something. I don't get a deduction for those. It's added to the basis of the property. Then when you sell it, you have just regular ordinary income. And the problem with flipping is they considered it a trade or business. If you're involved in it and you're participating, then you have not only ordinary income tax treatment, but you also get old age, disability, and survivors, and Medicare. You get employment taxes on top of it, or FICA, Social Security, whatever you want to call it. It's that 15.3% employment tax. You get to deduct half of it. So it ends up being 14.1% of the first 100,000, or, first 170,000, and then it starts to phase out and go down a little bit. But point is that you have this employment tax on it. If we don't want those employment taxes, then you got to use a corporation. And we're either going to use an S corp. If you need all the money, pay yourself a small salary, use a 401k, use a DB plan if you want to just pay no taxes. You don't know what a defined benefit plan is. I did a video on it actually with Jeff Mason and Chris, his partner, about a week ago, 2 weeks ago. I think it posted. It's about 100,000. I think it's on my YouTube channel. Maybe Patty, you could find that link. I'm sorry to make you run around and chase things, but yeah, but it's something called a defined benefit, where you're actually calculating based off of what you're used to making and what you would need to have to continue to make that when you retire. And so in some cases, we get over $1 million a year into these plans. I think they detailed one that was 1.2 million a year for somebody. So let's just say you're flipping houses and you're making $300,000 a year. You're like, this is great. I have other investments, but I'm getting killed in taxes. Could I mitigate that? You could actually set up a corporation, an S corp or a C corp, and yeah, you could probably mitigate the entire amount. It depends on how much. So if you're flipping 3 houses, typically you do about a house a quarter. So I'm assuming if you're doing 3, you could be doing as many as 12 during the year. Be interested to find out how many you're actually doing, because that could be sizable income, in which case you're saying, hey, I need to reinvest some of this, but I don't want to get killed in tax. And that DB plan or the 401k could be an easy component. And then, as Elliot said, you could either choose S status, where it flows down to your return, and you take a salary, maybe do a 401k, again, maybe do some tax mitigation. The rest of it flows down. You could spend it as you see fit, and you avoid the employment taxes. Or you do a C Corp and you're keeping it off your return completely unless you decide to take a salary. And that's usually when you are stockpiling it. So like if I am in a situation where I want to keep flipping and I don't need the money personally, I'm flipping and I'm trying to build that side of my portfolio up and I want to do more and I'm just reinvesting that money, it may be better to have it taxed to that 21% than having it hit you personally. A lot of this is easy to explain when you actually start looking at your numbers. So if we did a projection, or if Elliot's team, for example, did a projection, which anybody, by the way, if you're an Anderson client, you can absolutely do that as part of our tax advantage program. When you join our tax team, or when you our tax program, you could say, hey, I want to have monthly or quarterly or twice a year meetings with the tax advisors. And what they're doing is they're doing these projections. You guys which softwares do you use to do all your projections?
We use one called Corby, and we use BNA, which is a Bloomberg tax product. Yeah.
I'm reading. Somebody says, Patty, Have you ever wondered how lost Toby would be without you? John, I'm lost with Patty. It would just be much, much worse. I'd be making noises like that all the time. See? Yeah. Wait, I think I still make those types of noises. That was our buddy old Howard Dean. Anyway,
Your
so
election.
yeah. Anyway, yeah. So just because I have to, just remember when you're flipping houses, it's no different than flipping pizzas.
There we go.
Pizza, pizza.
Can't let one go by. All right. I bought a short-term rental cabin in May of 2022 using 1031 funds. Rentals are beyond disappointing. That's sad. At this point, I will sell for at least a $200,000 loss, more than the gain on the 1031 funds. How does this play out regarding taxes?
Yep. A lot going on here. First of all, just step back. What's going on with the 1031? This individual had a property used in a trade or business. They sold it. We call that relinquished. And then they picked up this short-term rental cabin as what we call a replacement. And that was done, we can pretty much assume from here, to defer the gains they would have had on that other piece of property had they gone through with the sale without doing a 1031. It's just a deferral of that gain. So fast forward to what our question is here. Maybe we're getting rid of it. We realize the value's not there for what we originally purchased it at. And we think right now, we're probably thinking it's a $200,000 loss from maybe kind of where we bought it at. But what we have to remember, the 1031, what's going on there, one of the reasons we're able to defer that gain is when we get rid of that property, it had an adjusted basis to us. Maybe it'd been a rental before, we'd bought it at 100,000, we depreciated it over time down to 40,000. That was the adjusted basis. Well, that basis carries over to the new property. So we may have bought this new replacement property a little bit higher, this short-term rental cabin, but our basis is going to be that adjusted basis from the previous structure that we got rid of. So I want to just throw that out there to the person asking the question. So we may not know exactly what our loss is. Well, let's just assume we do have that loss. When we have losses, the one thing we don't have to worry about is depreciation recapture because we have no gains. We'll never have depreciation recapture if we don't have capital gains. And if we have an overall loss, if it does equate out there, then we just wouldn't have taxes. We would have a loss, probably capital, more than likely loss. And in that case, it would go, you can take that against other capital gains you have or up to 3,000 for a long period of time. Yeah, that's capital gains, capital loss.
Yeah, it would, well, actually, if you sold it, it would be released and become
yeah.
ordinary loss no matter what, right? You're going to get to offset your W-2. So the question, like, again, the way to think of this in my brain, I bought properties for $100,000 and I depreciated them 20,000. So my basis is 80 and I buy new properties for 400,000. So I sold the old ones for 400 and bought new properties for 400. My basis was 80, right? Well, the basis in the new properties is still 80. So if the 400 becomes 200 and I sell it, it's going to be the difference between the 80,000 basis and the 200. So I'm going to have gain of 120,000. So I'll have a little bit of recapture, the 20,000 plus I'll have $100,000 of long-term gain, assuming that you didn't depreciate the cabins at all. So it won't be quite that clean, but that's how my little brain thinks of it. So should you be 1031ing into another property? That'd be the question.
Yeah.
And you might want to talk to a 1031 exchange facilitator to see if that makes sense. If you don't want, if there's a taxable event, but like Elliot said, if this is loss, so let's change the scenario. Let's say that you bought the first properties for 300,000 and you sold them for 400,000, bought new properties at 400 that are now worth 200, you would have a loss. You would actually, your basis would carry over. So that 300 would come over. The depreciation would obviously lower that a little bit. But regardless, you'd end up with a loss. You wouldn't have taxable income and you would have, if you sold them, some ordinary loss, believe it or not. It sounds weird, but you'd have some potentially some ordinary loss or some capital loss. Well, I guess
Release the PALs. Yeah, would release.
the release, would it
You're-
release? Yeah,
yeah.
release everything.
Yeah, I was wrong about the capital. Sorry about that.
Oh, we're always, we do our best. All right. I have multiple LLCs. Do I have to file multiple tax returns?
We get asked this a lot. Okay, so As we always say, it depends on how the LLC is taxed. If it's a disregarded entity, which just again means it doesn't file a return, its information, its income and expenses go on the tax return of the person or entity that's disregarded who owns it. In that case, well, the LLC doesn't have to file a return, but that individual or entity does with that information on it. But if it's a disregard, no return for that specific LLC, at least at the federal level. If it's taxed as a partnership, an S-Corp or C-Corp, well, then yeah, it's going to have to file a return. And then you always kind of want to look at your state because they're all a little bit different. Most of them go with the federal rule that if they are that type disregard, then they would not file a return. But it does depend on how that LLC is taxed.
And an easy way to think of this, most people that are pretty good structures, if you have multiple LLCs, chances are you have a holding LLC holding them. So if you have a bunch of properties, let's say you have 5 or 6 properties in separate LLCs, 99.9% of the time, you're going to see a holding LLC in one tax return, that partnership return for the holding LLC. You would not have individual tax returns for those individual LLCs, except possibly for if it's positive income for the state income tax, like whoever the owner is, or that partnership might have a state income tax return, but you wouldn't have a federal, so you wouldn't have a whole bunch. Now, it used to be, and there's still a few people that do this, but you'd find accountants that would set up multiple LLCs and tax each of them as a partnership so that they could do a partnership return. And they always try to justify it in some way. Oh, we want to keep them separate. Well, you kind of want to just do a partnership return, let's be real. Like if I have 7 LLCs and you're doing 7 different tax returns, that doesn't make a lot of sense when you could set up a single entity to own them all and then you could do one every year. It's just going to cut down the number of returns you're doing. So sometimes accountants get their dander up a little bit when they've set somebody up that way and they're like, how dare you? And you're like, well, just call it as I see it. I'm sorry, but it seems like you're doing a lot of returns, probably charging a minimum per return, and it might not be the best for the client. If they're commercial properties, I get it. Like if you have separate apartment complexes and there's underwriting when you sell it, I get it. There should be some sort of factor like that. But you see individuals that just have a bunch of single family homes and they're all partnership returns. I usually,
Yeah, we actually run into that same scenario for those clients who don't have, it's not rental, it's just really regular businesses. They may have 10 S corporations. Well, we might be able to do something there to consolidate, and we call it Q subbing, where you just have one return. You went from 10 down to 1. You still have your asset protection amongst the little S corporations. So,
done that more than once where
Yep.
the accountant gets really pissed because you'll have it like we did this with franchises where they had all these different companies and it was like, why don't we just do a Q sub, have a parent, even on the S corps, you could do this. If they own the qualified S subsidiary, which is what the Q sub stands for, it's a disregarded entity into the parent. On QuickBooks, you just make it a class, right? You just make it a class underneath the one set of books. It ends up saving you on bookkeeping and it ends up saving you on having to do 10 different tax returns. Now you have one. The accountant gets mad because their bill just went from $12,000 a year for doing those returns to 2,000, right? They get mad a little bit. To be expected. And sometimes they create complexity for their own benefit. I don't think they're, I don't know.
They may be ignorant of it all.
They may be ignorant, but yeah, but there's a way. Usually there's a way to cut down on that. And the question is always this, because we get this with real estate all the time. If I have a cash buyer, I'm going to make disregarded entities and I'll probably have 0 partnership returns for the real estate. If you're a cash buyer, you're not going to do financing and you're not doing commercial, you're just doing single families. I may say, let's just do it the cheapest way possible. Maximum benefit. You're not losing anything. You could still have a management entity in there or a family office that you could pay. You could do that with real estate. It doesn't work with stocks, but you could do it in real estate. Just keep it really simple, right? And sometimes that's better. And then people hear something, even at our events, they'll be like, because Clint's always talking about partnership and it's better for underwriting when you're doing Freddie and Fannie, you could use 100% of the income because it's on page 2 of Schedule E instead of page 1. Hey, if somebody's trying to buy it, they need a tax return. I get all those things, but that's not always present. Then you should be open to the idea, hey, I don't have a tax return on my real estate, it all just goes on page 1 of my Schedule E, and my life's a lot simpler. Okay. I just don't want you to hurt. We're always going to say, here's the good, the bad, and the ugly, so that if we could keep some dollars in your pocket, it's better for us because we want you to be successful over the long term, for sure. I have had my primary residence for the past 21 years. If I rent it for 3 years or more and sell it, would I be taxed on the depreciation I take over those 3 years? Or would it be included in the 1031 or the 121 exclusion? I'm immediately going to that 1031.
Right.
Bad Toby.
Yeah, no, well, there's a lot going on in this question, actually. It was our primary residence. First of all, let me go back to what 121 is. That is the exclusion. If you sell your primary residence, if you meet the conditions, which we'll go over, then you can exclude up to $250,000 if you're single, 500,000 married filing joint. So what this individual is trying to get at is they've had their primary residency for many, many years. They've owned it, used it as their primary residency for over 2 of the last 5 years. That's the 121 rule. But then they rent it for 3 years. And if it was exactly 3 years, then they could take advantage of that 121 if they were to sell it, and maybe even the 1031, as Toby was kind of alluding to there. But if they go over that 3 years of rental, then they go outside of that. You owned it 2 years within the last 5 years for the 121 exclusion, meaning they wouldn't get any exclusion if they sold it. So it's right on the borderline that they picked that 3 years. However, the fact that they did rent it, let's say they only rented it 1 year, but they'd had it the past 21, well, they could use that 121. They've owned it, use it 2 of the last 5 years, get the exclusion. And then because they put it in a trade or business, as Toby was going to, you could do the 1031, which we alluded to earlier, and maybe defer some of that gain. No depreciation recapture in that case. Otherwise, yeah, you'd have depreciation recapture.
Mm-hmm. So let's play some scenarios here, and let's talk about what you could do to avoid having a negative occurrence. So what we have is the 121 exclusion, which is a capital gain exclusion. If you're married, it's 500,000. If you're single, it's 250,000 of capital gain, not recapture, capital gain. So if you rent your primary residence, the rule is if you've lived in it 2 of the last 5 years, used it as your primary residence, when you sell it, you get that capital gain exclusion, 2 of the last 5 years. So that's why if you lived in it and then you moved out, you actually have 3 years of which to take advantage of the 121 exclusion. There's one other caveat. You could not have taken a 121 exclusion for 2 years, right? So you can't do more than once every 2 years. So if you moved out of your primary residence, rented it 3 years, but in 2 of those years bought another primary residence and then sold it in 121, you'd be ineligible to do it because you can only use it every 2 years. So let's just say that's not the issue. You moved into another place and you're going to keep this property and you're like, oh shoot, I'm going to lose this capital gain exclusion. So let's use some facts. Let's say that you bought this primary residence 21 years ago for 250,000. Let's assume that it's worth 750,000 now. So we have $500,000 of gain. If we sold it right now, you would have 0 tax. None, because you have a 121 exclusion for 500,000. It would all be gone. Now let's say that you waited 2 years and the property value goes up to 800,000. And in that 2 years, you took depreciation that saved you 15,000. So you would lower your basis. 250 is what we bought it for. So we'd be down to 235. We'd have $500,000 of capital gain exclusion. So that would get us up to what, 735. And anything over that, let's say we sold it for 800,000, would be taxable as we'd have some recapture on the 15,000, and then we'd have some long-term capital gain. If you want to avoid having to sell it and you just want to grab that $500,000 of exclusion and you want more depreciation, let me give you the solution. You are going to sell your primary residence right now to an S-Corp. You're going to set up an S-Corp and you're going to buy it from the S-Corp. Here's why you're doing that. Because when you do that, the S-Corp is a separate taxpayer, according to the IRS, and this has already been vetted out, the S Corp could now buy it on an installment contract, which we can't treat it as an installment sale for tax purposes. It won't matter here in a second, but that way you're getting payment. The rent's basically coming out as a payment, and you're going to see why it's not going to matter, because you're using the capital gain exclusion to have zero taxable income. But now the basis of the property is that 750,000. And now you could rent it out and depreciate it 750,000. How much taxable income will you have from it? Zero. I mean, it's gonna offset that income. So it's, somebody may be giving us another scenario. I'll have to look at that. Oh, it's something else that's not gonna help me. Ooh, I thought that might be this person. All right, so we get the capital gain exclusion, and now we could just hold on to it forever, right? And if you ever wanted to sell it, you could 1031 exchange the difference. Now you have a new basis of 750,000, and then you sell it, let's say in 5 years, 6 years, and you want to buy other investment property, and this thing's now worth $1 million, you could sell it and pay no tax. Your basis is still that 750 minus the depreciation. So it ends up avoiding the tax hit completely. If you lose that capital gain exclusion, that is worth at a minimum to you, probably about 15%, probably closer to 20. 500,000 is going to be at 20 if you have any other income. So let's just say it's going to cost you, you're going to lose about $100,000 of tax benefit. So we may want to take advantage of that, step up your basis, you keep it. And I know people are freaking out going, you're in an S Corp though. Yep. Don't take it out. Don't refi it and take it out, because that could be taxable, but you have a new basis set, right? It's only on the value of that it goes up. So it doesn't hurt us to have that S Corp. The income made inside of an S Corp keeps its nature, so it's still passive rental income. We get a higher amount for depreciation. It's cash flowing out to me. I'm not having to pay tax on it. If there's interest, I might have a tiny amount of interest that it has to pay me. But boy, what a much better scenario than losing that 121 exclusion. And I'm sorry if I lost some of you guys, but this is the way that a tax planner thinks.
Yep. This has so many options to it. A lot of good stuff that you can do here.
Yeah. The other route is you just sell it within 3 years. Like I live this. I had a primary residence that I moved out of, about 1.5 years ago, and I just made it into a rental, like furniture and everything. I just rented as a corporate rental. So I have 3 years from that date that I moved out to either do the S Corp and sell it to it, or just to sell the property and use my 121 exclusion. As of right now, I'm more than my 121 exclusion, but it would still, I could use the 121 exclusion and the 1031 exchange, because now it's an investment property. You use the 121 exclusion to offset the capital gain first, you use the 1031 to offset recapture and any other gain. So you could do both, believe it or not. It's kind of crazy. The IRS shows us how to do it. It actually spells it out, and it anticipates that so that you could do it. And it works out great. You could actually buy a replacement property and get this, rent it out for a little while, and then move into it. The 121 code actually anticipates that and says, hey, you can only do that every 5 years, right? Because it's such a huge tax savings, especially for you guys in California and New York, where your properties have gone up $2 million or something. What the trick there is, take your property that was your residence, turn it into an investment property, do the 121 and the 1031, acquire a new property as an investment property that you might move into in 2 or 3 years, and then move into it. And it works like a charm, like crazy good. All right. Anything I missed on that?
No, I think we give them enough.
Are your brains hurting? Give me a thumbs up if your brain hurts, because this is the mad scientists of tax. There we go. All right,
Need
here.
the aspirin now.
Not aspirin, wine.
There you go.
Wine works, preferably red.
I'm a red.
Yeah, so, and it makes everything make sense
Yes.
after a while. It makes you smarter. About a bottle in, it'll make sense. Maybe. Or you won't care anymore. Bottle in, you won't care that you don't know what the hell did he just say?
I don't know.
Who cares? All right. This would be a wine watching party. All right. I have a 2-level house and I live on the upper level. but Airbnb on the lower level. Can I deduct the depreciation, repair, management, etc. on the lower level? Does it need to be a legal unit, have its own address? Same question, but what if it was a long-term rental?
So I'm going to start at the end here, just as far as the difference between short-term rental, long-term rental. That really doesn't matter in the sense that the treatment will be the same with one caveat that I'll get to here in a second. However, you're going to be able, because you have rental income coming in, assuming from renting this out, you will be able to take these expenses that you mentioned here, the depreciation, repair, management. It's just a matter of how much. And because we are living in the same house, it very well might be that you might be kind of limited to how much of that you can deduct because you're kind of renting out your personal residence. You may only be able to rent out up to the amount of income you have. However, you mentioned, does it need to have a separate kind of legal unit, its own address? If it has its own ingress and egress, way in, way out, has its own kitchen, living room, stuff like that. If it's its own separate facility, well, then you really have almost, in a sense, a duplex here, two different units, and then you can run that completely separate. And then we look at if it's a short-term rental, well, did you materially participate in the management of it, which we would assume you would because it's in the same building. You have to be the one running it, managing it, don't want to pay a third party to do so. Or if it's a long-term rental, you have to have that real estate professional status in order for this to be not a passive loss, but it has to be, then we get an ordinary loss. That ordinary loss, then you'd be able to take more of those expenses. You talk about the depreciation, the repair management to create that loss.
Yeah, so basically, yeah, you don't lose the ability to do it. It's a residence, so you're not going to have the ability to take losses. That's basically the takeaway here. It doesn't have to have its own address. How would you structure it from an asset protection standpoint? I'd probably put it in an LLC and isolate it from its other activities. You cannot hide it from the rest of your property. Most states have a homestead exclusion on a portion that is a primary residence. I don't think you destroy it by renting out some of it. But again, you want to do case by case. What I would be doing if it's me and I'm renting out a lower unit is I would have either a mortgage against it, whether it's a friendly mortgage with something that's loaning it to me that's mine. If I was going to buy it for cash, that's what I would do. I would loan the money from a third, like I would have my LLC loan me the money, put a deed of trust against that. So it has very little equity. I put it in an LLC so that it cannot hurt me if the downstairs tenants do something crazy. And I've seen just recently more than $1 million for somebody stepping on a nail. They were in a wheelchair and they stepped on a nail. I don't know how you step on a nail from a wheelchair, but they managed to. And the insurance company settled out, and then they left the landlord hanging out to dry for an additional amount. Yeah, it was crazy. It was over $1 million.
That's terrible.
Yeah, it's bonkers, some of these claims. You want to have some real fun, look at what they do with mold in California.
Yeah.
It's like, holy kashmoli. I could have brain damage. Clearly have brain damage. You're suing somebody for fake mold, but they get rewarded for it. So, anyway, what did Ed McMahon get? 7 million for this,
Yeah, that's right. I forgot
for his
that.
dog.
Right?
And that's not a joke. That's
I
actually,
totally
you could go
forgot.
look it up. Look, Ed McMahon lawsuit mold, and he got like 7 million bucks because his dog got sick and passed from alleged mold in a house. Like, this is crazy. So you just never know what's going to come your way. So you want to isolate that liability, put it in LLC. I've had people win that lawsuit and still lose 250,000 having to defend it, right? Because these people have no money. And if they lose, oh yeah, Patty just put the mold case. Is it 7 million? I kind of want to click on it, but I'm afraid that'll like kill me. Like it would take me away. Yeah, Patty, how much did Ed McMahon get? Was it 7.2 million? Oh, there we go. See, I'm not too crazy. 7.2 million.
A lot of cash. Even after you pay the lawyers a third.
But then he had to sell the house. And they were all like, but it has toxic mold.
Yeah, who's gonna buy?
Yeah. Isn't this the poisonous house? Yeah. It's the last thing you want as a landlord. Not only did I poison the tenant, according to the tenant, I mean, it's stupid. These guys come in, like we had one where they flooded the downstairs of a house. Not kidding. The kid flooded the downstairs. It got the carpet wet. So they decided they had mold. So they called in a university professor who was a specialist in mold, who went in there. They tore up the carpet, threw it away, didn't tell the landlord, of course, and then sued him for millions of dollars, saying, see, it was mold. Okay, you threw away the carpeting. We didn't even see the mold. Oh, but it was there for sure, and they did it. Just silly. It's crazy stuff. Some of the stuff that we saw.
I had that in an apartment once, but I was not about to sue anybody over it.
I'm gonna do a video on this one. This is God's honest truth. We have a news organization that's our client, and they outed a pedophile who was trying to steal a child, and they got the camera footage from the police, and they broadcast it, and it got 4 million views on YouTube, and they're being sued by the lawyer for defamation. There's a lawyer that actually took that case, and of course, because I'm a nominee on it, they sue me too. They always like to do that, and I'm always like, you can sue me all you want. I'm gonna put you on my YouTube channel as soon as the lawyers are like, go ahead. I'm gonna like put that out there. Like, that's great. You're a pedophile, and you're gonna sue the person that took the police's camera. This is how crazy our world is right now. You could pretty much sue anybody for anything at any time. And it's absolutely bonkers that these lawyers, I think some of them are starving because they just take absolutely crappy cases. All right, you want to learn how to defend against that, make sure this never hurts you.
Talk to Clint.
Yeah, talk to Clint at the Tax and Asset Protection Workshop. I sometimes am on those too.
Oh yeah.
Is it possible to sue Ed for the paper cut I got opening the publisher's clinic? They've been absolutely torn apart, John. Like, Publishers Clearinghouse has been sued as like all over the place for false and deceptive stuff. And anyway, I don't like some of the lawsuits we've seen with our clients are just really sad. We had one, oh gosh, I could just tell you guys stories all the time, but there was a guy and he was going to sell a house. Somebody said they wanted the house, so he was going through the background. In the meantime, somebody applied and they said the house is taken. Well, that person that applied was a minority. The person that they were going to rent to didn't pass the background check, so they put it back on the market. So they got sued for discrimination because they said you did not rent to me because of my race. They didn't even know the race. They just said, hey, the house is no longer available. So they ended up getting like nuked. It cost them all their properties. They got absolutely destroyed because the government got involved. And at the end of the day, all it was, hey, we were going to rent it to these other guys. It doesn't matter. They beat the heck out of you. It's so you want to learn how to make sure that doesn't happen to you. Then come to the Tax and Asset Protection event. Clint's got really good stories too. We have tons of stories that we like to share. Clients that we've actually had siblings. One sibling got tased, they just went after him like a dog goes after a bone. Our client they let out. We just had this happen again. I'll give you another one. And they let out, well, they're siblings. And the rich sibling was our client, but they couldn't see that he had anything. So they thought he had nothing. So they let him out of the lawsuit and they just attacked the other sibling. And we're like, that's the difference. One guy, you can't see what he's got. The other guy, they could see everything he had. And even though it was less, they still went after him. That's actually how I learned about Nevada. Was up in Washington. There was a lawyer that settled with a guy who ended up being an heir of a big family and having a ton of assets, but they couldn't see what he had. And they settled with him because they thought he didn't have anything.
That's the way to do it.
And then they got really mad when they found out that he had millions of dollars. And so I had to look at it from a malpractice standpoint to see whether or not it fell below the standard of care. And I was like, how the heck do you know? Like, you can't see what these guys are on. You should have gotten a declaration from them as to their financial statement, and they didn't do that. But at the end of the day, you don't hold the lawyer responsible for it. You settled because you didn't think you were going to get anything if you won.
That's why we work with these guys.
Oh, there's some crazy cases. We had another one in California. Gal got sued as part of, like, they were just suing everybody and their mother on a transaction. And she was freaked out. And I was like, don't worry. I'm trying to say, like, chances are you have insurance and you don't have they can't see anything you have. Well, it got better within 6 months. This is California where they could sue a ham sandwich. And they let her out because they couldn't see anything. They said, well, we only want deep pockets. So she was kind of like, wait, are you saying that I'm poor? Because shush, take that.
Take the insult.
Walk away. All right, let's go to it. I'm a real estate professional over 750 hours per year, actively acquiring properties. And I sell my other long-term real estate investments, such as stocks or private equity, private venture capital investments. Then can the losses from my active or passive real estate investments offset gains on my other long-term non-real estate investments?
All right. So starting at the first definition of real estate professional, you're right, 750 hours. But before we try and get that status, we want to look at what happens when we have rental real estate. In the normal in the code, the normal status of that income you have coming in is what we call passive activity. So if you have passive income, it's passive income. If you have losses, it's passive losses. You can only use the passive losses to offset other passive income. So you may get income trapped, or excuse me, losses trapped. We call it suspended passive activity loss rules. That's why this individual is going for the real estate professional, because that wipes it all out. And then if you have any income or losses coming from those properties that you are the real estate professional over, then that becomes a non-passive, and you can use those losses against any other income on your return. Now, usually when one does this, we have a lot of clients who have real estate professional status. Normally, you make an election that year to aggregate. You pull all of your real estate activity, maybe a short-term rental, maybe some that you don't even manage. But as long as you met the rep status requirement and you aggregate, it pulls it all in together. Why does that matter? Because at the second to the last line here, you mentioned all the activity from my active or passive real estate. Well, we don't have any more passive real estate activity. That doesn't exist. It's all active or non-passive. So if we have overall loss from that, yes, that's going to wipe out any income on your return. I don't care if it's your W-2. I don't care if it's capital gains. I don't care where it came from, what investment. It will wipe that out if you have enough loss for it.
Yeah, so there's two types of income and two types of losses here that we got to pay attention. Actually, three, if you want to get technical. So you have your ordinary income, wages, anything that you make that's ordinary income. You have your capital gains, and you have your passive income. Passive income gets offset with passive losses. Capital gains get offset with capital losses. So when you sell your stocks, private equity, venture capital, that's going to be long-term capital gain. So long-term capital gain can be offset with capital losses. If it's passive capital gain, like from real estate, then you could actually use passive losses to offset it. Or you can use ordinary loss. So there's three types of losses that could potentially offset that capital gain. So that's the first thing I want to do is isolate that. Say you have capital gains. What kind of losses can offset it? Ordinary, capital, or if it's passive capital loss and you have passive capital gains. We can eliminate that third one already because this is stocks or bonds or stocks or private equity. So these are going to be non-passive. They're just going to be capital gains. So we need capital loss or ordinary loss. So now you have real estate professional status where your long-term real estate investments are creating passive losses that you want to have treated as ordinary. So the exception to the rule, when you have passive losses like that, the exception that makes it ordinary is real estate professional. Two steps to qualify as real estate professional. Number one, 750 hours in a real estate trade or business that you materially participate in. So if you have actively acquiring properties, I got to look at that and say the only time they're going to count towards that 750 hours is properties you actually acquire. So if you are in a business where you're just actively looking around for properties, they're probably not going to count that. They're only going to count the time that you spend acquiring properties. So I don't know whether you're going to meet the 750 hours. Let's just assume that you are and you meet the 750 hours. Then there's a second part, which is you materially participate on your real estate. That's your long-term real estate, right? Your real estate, those particular investments that you want to be treated as ordinary. So there's two things you do here. You aggregate them and treat them as one activity, and then you have to meet one of the 7 material participation tests. There's 7 ways to qualify. Either you do all of the management of those properties, you're the only one who does anything on it, which is really tough, Number two is you do more than 100 hours and no other individual does more time than you and your spouse, and you do over 100 hours. Number three, you do 500 hours and we don't care about anybody else. Those are the three that would really qualify for you. There's four others depending on what you've done in the past. But let's just say this is the first year we're looking at this. That's the analysis that you do. Are you a real estate professional? Did you materially participate on your properties? If the answer is yes, then those losses are no longer passive. They're ordinary loss. And yes, you could use your ordinary loss against your capital gains. But the big question is, would you? Why would you? Because all of those real estate invest or non-real estate investments are long-term, which means they're going to be taxed at 0, 15, or 20%. They're not horrible. This isn't 37% tax here, unless you're in California, in which case you get 20% plus it could be 13.6 plus the net investment income tax. You could be up at 37% anyway. So, right? Here's the answer to this question. Get someone to calculate it for you. Get with somebody like Elliot or one of our team and have them actually run the numbers so you can see whether or not it's something you want to do. If I have the choice to take long-term assets, I may be at 0 and 15%, right? So I may say, oh, it's not so bad. I thought I was going to be much, much higher, and I'm okay. So again, you just want to get that the pencil out. I used to joke, and it's not really a joke, but it sounds like one. What are the top 3 rules for tax planning? It's calculate, 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 right? You always just get a calculator out and you start figuring out what the tax is. If I do it this way versus if I qualify over here, is the juice worth the squeeze? Sometimes it is, sometimes it isn't, right? You may not want to jump through that hoop. It's only going to save you $5,000. If it's going to save you 50, you're going to jump through the hoop. So I hope that helps.
It's excellent. Excellent.
All right. How do you minimize capital gains when you sell your condo that you lived in for 2 years that has never been rented? It is not your primary residence.
So the capital gain here, because we've lived in it for 2 years, but we never used it as our primary residence, this is going to call all the way back to when we were talking about the 121 exclusion. Again, as Toby laid out there, you got to own it and you got to use it as your primary residence for 2 of the last 5 years, and you cannot have taken the 121 within the last 2 years, last 2 years. So we know that's not going to be, we can't use that. We got capital gains coming in. We never rented it. So there we had no depreciation recapture. So that's good, I guess. You're just looking at capital gains coming in here. And so how are we going to minimize? You have to look for other things. If you've had an investment, you bought Bitcoin at the wrong time, you bought high, sold low, you have some losses there, other capital losses, as Toby just went off, that would offset your capital gains. If you have anything hidden, bad investments like that, or you look for other things on your return. If you have other real estate investments that maybe you can do to sell it and create losses or something like that, but you're really looking outside, and this is where you're going to really need tax planning to try and wipe that down. So we can look at these other avenues. If you are into real estate, maybe have a short-term rental, bonus depreciation, those old standbys, or maybe set up a nonprofit, defer it by putting off into that. But other than that, you're really going to have to look at it and get some planning.
Ordinary loss and capital loss could offset this type of income. This is a residence, so it's not an investment property. So you're not going to have passive income. You're going to have capital gain. So you're going to offset that with capital loss or ordinary loss. So you're looking around for those. If I wanted to minimize the tax hit, I might reinvest that money in oil and gas because you could create a loss. I might give it to charity or donor advised fund to offset it by saying, hey, here, I can offset this gain by making, you would do the math. It's not going to be, you wouldn't have to do this big because you'd use the charitable donation against your ordinary income, which would be higher than your capital gains. Always, right? So you don't have to do like dollar for dollar. You might be able to offset that tax with a much smaller gift. Same thing with the oil and gas. It creates an ordinary loss. You might harvest some tax loss, like right now when the market pulls back. Guys, here's a secret. When they lower the federal interest rate, and there's about 100% likelihood they're going to do it in September, although it's not 100. There's always the chance they don't. The market tends to crash afterwards. Just a word to the wise. Every time they do that, it seems to go down. It's not a straight line. Sometimes it has big days, but like some of the biggest trading days in our history are 2008 and 1929, right? It's when the market's taking a ride down, sometimes it blips up. You can harvest loss if that occurs, and then buy back something else. There's ways to get around the wash sale loss rule. If you've watched some of my videos, you know that you could buy an option, buy back the stock, sell the option, the loss attaches to that. There's lots of mechanisms that you could do to get around these, but you're harvesting tax loss just for the purposes of using it against the capital gain that you have on the residence. That's what I'd be looking at. I'd be looking at all those things. If some of you guys, again, sometimes your brain breaks when you're doing this. It's a little game. Once you realize what the pieces are, you're like, oh, that's not so bad. But it's kind of like trying to describe Monopoly in words as opposed to showing you. Yeah, we're a little bit over. All right. If you guys like this type of information, by the way, this should be fun. Like you guys should be looking at this and thinking, hey, this is kind of crazy. But use it as an opportunity to play it like, again, it's like a game. What are the rules? What do I need to do to offset this? A lot of times we react, right? Oh gosh, I sold this. I'm going to have a capital gain or capital loss. You don't realize that there's actually things you could do. You know that we could do things for 2023. We could still do cost segs, DB plans, 401ks for last year with money from this year. Yes, there are things you can do to offset your tax and still do some tax planning if it benefits you. You just look at it and say, what is the benefit? And I always say, is the juice worth the squeeze, right? If I'm going to get a 5x, 7x, 10x return on $1, I'm probably going to do it. If I'm going to double it, probably not. It's probably not worth it. But go to the YouTube channels. Clint has a great channel. I like my channel. I'm biased. I think mine's awesome because I create videos all the time. Go watch a few of them. Like they're kicking the pants. There's only 800 and I can't read what it is. It's 800 and something. How many do we have? I can't read that number.
Can't even see it. Where's it at?
It's right here. There's
870?
870.
Wow.
There's 870 videos to play with. That'll be fun. I know it's over 800. I just couldn't remember the number.
That's huge. Into that 1 century.
Sorry.
1,000.
Yeah, don't watch them all at once. But look around. There's all that stuff. Like, so, somebody was asking me for a flow chart on the house, and things like that. Go in there. It says like if you're selling your house, here's how you avoid the tax on it. Go through it, break it down, and then you could watch it over and over again. You could share it with your accountant, or you could reach out and say, Toby, you're a nut job. Where's the backup to what you're saying? Everything that I talk about, there's going to be a backup on it in code. So I could say, here it is.
Got Labor Day weekend. They can binge watch.
Is that coming up?
Yeah, a couple weeks.
Yay, binge watch. And then always come to our tax and asset protection workshops. They're free. You can learn all these things. Clint, myself, Brent Nagy, Amanda's on there sometimes. We all rotate around. I usually do taxes and legacy planning because I happen to think that it's really important to create a legacy for your kids. Leave your values behind. And in the next 2 weeks, while you're waiting for another Tax Tuesday to come around, ask Elliot questions at Tax Tuesday at Anderson Advisors, and you could always visit our website. Now, I got to call out Troy, Summer, Rachel, Jeff, Jared, Dutch, Arash, Amanda, Patty, and Matthew answering questions all day, over 150. There's still 7 open questions. We're going to say adieu and stop our presentation, but those of you who are waiting for responses, you can go ahead and wait. They'll answer your questions before they go off. So I'm just going to say thank you so much for allowing us to entertain you. Hopefully you got some entertainment out of it for the last hour, and to do some tax madness. And hopefully you're not as nervous or scared about taxes, and you realize that it should be kind of fun, and that it really is. There's tons of incentives if you know where to find them. There's ways to offset that gain. And as Justice Rehnquist once wrote, there's nothing illegal about a plan to avoid the payment of taxes. The Internal Revenue Code does not prevent that. Tax avoidance is absolutely illegal. Tax evasion gets you an orange jumpsuit or a striped jumpsuit, depending on where you're at. In either case, you don't want that. There's plenty of legal ways to offset your taxes that are legal, ethical, and if you're willing to jump through a couple of hoops, you get that big benefit. So I'm going to say thank you. Anything else?
No, thank you so much.
All right, we'll see you in 2 weeks, guys.